So in the previous lesson, we've now kind of looked at slippage, and we've realised how that can happen when there can be volatile events in the market, and when you combine that with sort of low liquidity, you can experience losing more than you had initially anticipated, right? More than the risk that you had originally calculated to potentially lose. Now, we know that one way we can prepare for this is to look at those planned news announcements, and then also avoid trading around those periods of time in the market when we know, around the Asian session and the daily rollover, around spread hours, right, when liquidity is to be low. But as we know, there can be unplanned events that can hit the market, right? Now, one of probably the most famous things, if you've been in the trading world, that happened was with the Swiss depegging in 2015. So some of you may not be aware of this or may remember this, but this was kind of around the time that I was really starting to get into trading when this happened. And let's just have a quick little look at what went down. So essentially, to keep a sort of long story quite short and simple, the Swiss bank was essentially pegging their currency to the euro at the rate of 120. So they essentially had this pretty much artificial floor within here that whenever price came down, they essentially did some really heavy selling with the Swiss franc, and they were buying euros with it, essentially to weaken the Swiss franc. So that would obviously see this currency pair go up, right? Obviously, if the Swiss franc itself is bearish. And then, a lot of traders knew this, and they knew that every time price came down, the central bank would step in heavily, essentially forcing the currency pair came up. So as we came back down around the end of 2014 and 2015, a lot of traders saw this as a pretty easy trade. Central banks going to step in, may as well trade on the side of the bank, right? So everyone was getting long down here. Now, I'm sure you can probably start to guess what happens next, but around kind of January as well, start of the year, not a lot of liquidity in the markets around that time, compared to other times of the year. And we just played this forward a couple of days, and then boom. Quite a few brokers and probably thousands of traders wiped out literally in the space of a few seconds with this move that came in. So they suddenly, completely unannounced, just got released to the market that the central bank were no longer holding that peg to the euro. And if we actually just measure this, they roughly, in one single day, that move peaked at just over 2,300 pips in a single day. Now, there's literally no words that can describe how insane of a movement that is, on this pair in a single day. And the amount of slippage that occurred, literally loads of brokers went under. They went completely bankrupt because a lot of their clients, right, accounts, they went into negative balance, and they owed money to the broker that they were never going to be able to pay back because, everyone who had got long, right, where do you think they put their stop loss? Just below that level. And then when this goes, right, there's not enough liquidity, there's not enough buy orders on the other side of the market to fill their sell order, right, to fill their stop loss. So then people were getting filled, all the way down here, or, not even getting filled, and just having a massive floating loss, which, the brokers were just not prepared for. The point of this isn't to scare you. These events are extremely, extremely rare. I mean, the chances of this happening, in your lifetime, or even just whilst you happen to be in the charts, let alone whilst you're actually in a trade, is pretty much next to zero. But you need to be aware that, anything can happen, and these events have happened, right? Something might not happen as drastically as this, but there could be a war, there could be a terrorist attack. You never know, and there can be insane periods of volatility in the market, which it can be hard to protect yourself from, but there are some things you can do, which we're going to take a look at now. So to reduce the risk from black swan events like the Swiss franc depegging and your exposure to any broker risk, we can use a technique called capital partitioning. So capital partitioning, it's a slightly more advanced risk management routine that traders opt for when their account grows beyond a certain threshold size and they wish to both reduce their exposure to broker risk and reduce the opportunity cost of having all of their trading capital tied up in their brokerage account. So segregating your account into different partitions, it acts as a hedge against the risk of having all of your funds in just that one account. So if your account size is £100,000, what you can do is move £50,000 into a high interest yielding investment account. Now, I appreciate in the current economic climate, there isn't really such thing as high interest at the moment, but that's the idea behind it. So you can move 50 grand into another investment account of some sort, a savings account, and then just double your trade size for each position that you then take in the market. Because you are still risking 1% of your total account size, right? So you're still risking 1% based on 100,000 in your account, right? Which is going to be £1,000. But because you only have £50,000 in your account, this will appear to the broker as you risking 2% per trade on your brokerage account, right? Because only half of your capital is actually stored in there. So whenever you are calculating your position size risk, you just need to remember to always add the amount of capital, the safe portion that you have put in a segregated account. You need to add this to your account balance in your brokerage account when you make that calculation, so that you are risking a percentage of your true account value, right? So capital partitioning, really it has two main benefits. The first is that in the extremely unlikely event that something happens to your broker and you cannot access your funds, then at least your capital is more secure since it is held in two separate accounts instead of just one. So essentially your risk is halved. Also, you can earn a guaranteed return from the other half that sits in a, quote unquote high interest earnings account. This can increase your overall return by potentially another 0.5 to 3% per year, right? It's better than nothing. Now, if you have a mortgage, you can also look into opening something called a mortgage offset account. So just do a little bit of research on that, and you may want to get some, financial advice. So since you'll be trading 2% risk on the £50,000 that remains in your trading account, this obviously has the same effect as trading 1% risk on your initial 100 grand account. So therefore you will receive the benefits and security of diversifying your parked capital, but with no disadvantage to your trading activity at all. So you can partition your capital with, say, a 50-50 split like we've just spoken about, a 60-40, or even an 80-20. But there are two rules that you really need to keep in mind. The first one being that you need to keep your safe portion of capital extremely liquid. So the portion of the capital that you remove from your trading account, you need to keep it liquid, and this means that you should not go out and buy an investment property or a car with it, for example, because if you hit a long run of drawdowns, then you may need to tip more money into your FX account to ensure that you have enough margin to keep trading. So remember, even though your account balance may say 50 grand, you are essentially trading a £100,000 account. So if you were to take a £20,000 drawdown, this will appear as 40% drawdown from the broker's perspective, although it's only a 10% drawdown based on your true account value. Now, the second rule is that your leverage ratio determines your partition ratio. Because if you trade 100 to 1 leverage, then you only ever engage a very small amount of capital, and risking 2% position is no problem. But if you only trade, say, 20 to 1 leverage, however, then you can start to run into some trouble when you're risking 2% across multiple positions simultaneously. And the lower your leverage, the lower you'll be able to pull out to your safe portion in another account. I would probably say that if you were trading lower than 50 to 1 leverage, it's probably not advisable to be using capital partitioning, because it's pretty likely you will not have enough available margin to open more than a couple of positions at a time. And especially if you're the type of trader who uses quite small stop losses, that means that your lot size is going to be quite large for your account size. Unless you have very high leverage, then capital partitioning is not necessarily going to work too well for you. So just to summarize, capital partitioning is a risk management routine that I would recommend for any student trading a large account, as long as you have pretty high leverage. And by segregating your account, you essentially encourage more secure asset diversification, and you also stand to increase your overall percentage returns, even if it's just a little bit at the moment with the interest that a lot of banks are just about managing to offer. So that wraps it up. See you guys in the next lesson.